It is Wednesday, January 28, 2026. I'm looking at the screens right now, and I have to tell you, the cognitive dissonance is absolutely, it's off the charts today.
It's a split-screen reality if I have ever seen one.
It
Serious.
really is. On one screen, I mean, you have the S&P 500. It briefly smashed through that historic 7,000 ceiling.
Double party.
Oh, it's a party. Champagne corks, confetti, historic highs. It feels like nothing can possibly go wrong. But then you look at the other screen.
And that's where the story gets complicated.
Complicated is a good word for it. You've got a central bank that just slammed on the brakes. You have Amazon gutting its corporate structure in a way we really haven't seen in decades.
And a literal civil war brewing inside the Federal Reserve. It's not just a disagreement, it's fundamental.
That's why we're here. This is the definition of a Theta Fuse moment, isn't it?
It absolutely is.
Yeah.
That tension, between the explosive growth in asset prices, the party on the left screen, and the structural decay, or maybe we should call it structural renovation, happening just underneath the surface.
That is exactly what we're here to unpack in this deep dive.
Yeah.
We are calling this the Theta Fuse episode because everything we are seeing, I mean, from the Fed's press release to the internal memos at Amazon, it all signals that the time decay on the old way of doing things has run out.
Fuse is burned down. It's time.
And we have the documents to prove it.
Oh, we do. We've gone through the full text of the FOMC decision. And let me tell you, the dissent letters, they are blistering.
Really?
Oh, yeah. And we have the internal HR strategy docs from Amazon detailing this anti-bureaucracy purge.
And the prospectus on these new Trump accounts that are somehow bringing Nicki Minaj and Jamie Dimon into the same room.
Which is a sentence I never thought I would say out loud.
Right. Nicki Minaj and Jamie Dimon agree on fiscal policy. But let's be really clear. Our mission today isn't just to read you the headlines. It's to find the signal for you, the listener.
The signal and the noise.
Exactly. If Amazon is firing humans to hire GPUs, and the Fed is risking a recession to kill inflation, what does that actually mean for you, for your career, for your portfolio?
The signal is there, but you have to ignore the noise to hear it. And today, the noise is just deafening.
Then let's cut the noise. Let's start with the most dangerous room in the world right now.
The Federal Reserve.
The Federal Reserve.
Dangerous is an interesting word for, a committee meeting, but today, yeah, I think it fits.
We have a decision. The Federal Reserve released their statement this afternoon. What did they do?
Right. And for the first time in months, the decision was to do, well, absolutely nothing. The Federal Reserve voted to hold the federal funds rate steady at a range of 3.5% to 3.75%.
So the pause button has officially been hit.
It has. And the context here is so crucial because we have to remember the momentum we were riding. This halts a streak of 3 consecutive rate cuts.
Right. September, October, December of last year.
Exactly. We saw cuts in September, October, and December of 2025. The market had gotten very, very comfortable with that easing rhythm. The expectation was that the slide would just continue.
And today, Powell and the committee essentially stood up and said,
Stop. We're done for now.
I want to take a step in here because we always talk about the federal funds rate and basis points, and I feel like eyes tend to glaze over. Let's use an analogy. I've always liked thinking of the federal funds rate as the water for the economic farm.
That's a classic analogy, but it works so well. It really holds up.
So if the water is too expensive, meaning you have high rates, the crops, which are the economy, they just wither and die. It costs too much to grow anything. But if the water is too cheap, if you just open the floodgates, low rates, you get a flood. You get inflation.
Precisely. And for the last few months, the Fed has been opening that tap just a little bit, letting more water in because they were worried the field was getting a little dry.
Okay.
But today, they looked at that field and they said, you know what? The crops are growing pretty fast on their own. We don't need to add more water right now.
Yeah.
In fact, they might be worried about drowning the roots.
And this matters to you, the listener, not because of some abstract economic theory, but because this cost of water trickles down into everything. It affects the 10-year Treasury yield, which is sitting at 4.24% right now. And that directly impacts mortgage rates. If you're looking at a house, the 30-year fixed average is hovering right around 6.09%.
Which, look, is not historically high, but it's certainly not the rock-bottom rates people were hoping for if those cuts had continued.
Not at all.
But here is where we really need to dig deeper. The headline is, Fed pauses. Fine. But the real story is the vote count.
This is where it gets really interesting, because usually these Fed meetings are let's be honest, they're boring.
Designed to be boring.
Right. They want to project unity. We are all data dependent. We all agree. But this wasn't a polite aye from everyone in the room. This was a 10-2 split decision.
That's it, a 10-2 vote. Dissent is relatively rare in recent Fed history, especially vocal dissent like this. Now, to a casual observer, 10-2 sounds like a landslide victory.
Sure, it's 80%.
But in the polite, consensus-obsessed world of central banking, 2 dissents is basically a fistfight. It signals a deep, deep fracture in the philosophy of the committee.
So who are the fighters? Who are the two who stood up and said no?
The dissenters were Governor Stephen Mirren and Christopher Waller.
And we should probably point out both of those men are Trump appointees.
They are, and they both voted against the halt. They wanted another quarter-point cut immediately. They wanted to keep opening that tap.
Okay, so is this just politics? I mean, it's really easy to look at that and say, well, the president wants lower rates to juice the economy before an election, so his appointees are voting for lower rates. Is it that cynical? Or is there an actual economic argument for cutting right now?
That is the trillion-dollar question. And look, if you strip away the political theater, and believe me, there is a lot of theater, Waller's argument is actually quite technical and, pretty interesting. He's basing his dissent on the concept of real rates.
Okay, let's unpack that. Real rates. How is that different from the number on the screen, the 3.5%?
So you have the nominal rate, that's the 3.5% on the paper. That's what the bank charges. But then you have inflation, right? And inflation determines the purchasing power of that money. The real rate is just the difference between the two.
So it's nominal rate minus inflation.
Simple math.
Simple math.
But with incredibly complex consequences. Waller is arguing that because inflation has come down, core CPI is sitting at roughly 2.6%. The gap between the interest rate and the inflation rate is actually getting wider.
Wait, hold on. So if inflation drops but the interest rate stays the same, the real rate actually goes up.
Exactly. The cost of borrowing, in real terms, gets more expensive every single day that inflation falls. Waller's arguing that by standing still, the Fed is actually tightening the screws on the economy.
Wow.
He's saying, we aren't just pausing, we're passively suffocating the economy because inflation is falling faster than we are cutting rates.
That's a fascinating perspective. It's like being on a treadmill. If you stop running, you don't just stand still, you get thrown off the back.
That is precisely Waller's view. He believes the water is getting heavier and more expensive by the day, even if the Fed doesn't touch the dial.
But Powell isn't buying it, and neither are the other 9 voters. Why? What are they seeing that Waller and Mirren aren't?
They're looking at a different set of monitors. They aren't looking at real rates as the primary signal. They're looking at growth. They're looking at GDP. And frankly, the numbers are shocking.
Shocking good or shocking bad?
Shocking hot. The U.S. economy, by almost every single metric, is running incredibly hot. GDP for the third quarter was 4.4%.
That's already strong.
Already very strong.
Yeah.
And the fourth quarter, the Atlanta Fed is tracking it at a massive 5.4%.
5.4% growth. Hold on. We are a mature, developed economy. We are not a developing nation that just discovered oil for the first time. 5.4% sounds, it sounds fake.
It sounds like an emerging market number, doesn't it? But that's the estimate. And when you have an economy growing at 5.4% and unemployment has stabilized at 4.4%, you simply cannot make the argument that the economy is suffocating.
So Powell is sitting there thinking, Waller, are you crazy? The crops are growing 5 feet a day. Why on earth would I add more water?
Exactly. That is the entire logic of the pause.
Yeah.
If the economy is growing this fast, the risk isn't a recession. The risk is that inflation ignites again.
Okay.
In fact, the Fed's language shifted in the press release today to reflect this. They actually removed a clause that used to say they were worried about downside risks to employment.
That was the subtle change in the statement, right? I saw that.
It wasn't subtle.
Yeah.
In the world of Fed watchers, that was a signal flare. By deleting that sentence, Powell is telling the market, and he's telling the White House, I am not worried about your job numbers. I am worried about the price of milk, and I am not cutting rates.
But this brings us right back to the conflict. You mentioned the White House. This dissent from Mirren and Waller, it's not happening in a vacuum, is it? It's happening in the middle of a war zone.
It is absolutely impossible to separate the economics from the politics right now. The relationship between Chair Jerome Powell and the White House has gone from strained to what I would call Tumultuous.
Tumultuous is a very polite way of putting it. I mean, we are seeing headlines today that are completely unprecedented. The Department of Justice has subpoenaed Jerome Powell,
A sitting Fed
a
chair.
sitting Fed chair, subpoenaed regarding renovations at the Fed's headquarters.
It's an explosive detail, a criminal investigation into the renovations of an office building. Now, on the surface, it sounds like a boring bureaucratic issue. Maybe some contractor overcharged for the marble in the lobby or something.
Right.
But you have to look at the timing. You have to look at the context.
They served the subpoena on the day of the rate decision, or the news broke today.
The news cycle hit right as the pre-meeting blackout period ended. In the context of Washington, D.C., this isn't about marble floors. This is a pressure tactic.
It feels like a squeeze, a very public squeeze.
It is a squeeze, and it's part of a pattern. President Trump has threatened to fire Powell repeatedly. His term ends in May, so he's almost out the door anyway. But the pressure is just relentless.
Right.
And the president has already moved to sack Governor Lisa Cook, and that case is pending before the Supreme Court as we speak.
So you have the DOJ serving subpoenas to the Fed chair, the president trying to fire governors, and Trump's own appointees inside the Fed voting against the chair. It's chaos.
And Powell, to his credit, was unusually candid about it today in the press conference. He basically admitted that these threats, including the subpoena, are efforts to control monetary policy.
He said that out loud.
He essentially called it out as an attack on the Fed's independence. He is basically saying, you can investigate the renovations all you want. I am not lowering rates until the data tells me to.
It's a game of chicken. The White House wants cuts to keep this economic boom going. Powell wants a pause to make sure the boom doesn't explode into hyperinflation. Who blinks first?
Well, Powell's term ends in May, so he might not have to blink. The market is already placing bets on who takes the throne next.
I saw the prediction markets moving on this. Who's the front runner?
They're pointing very heavily toward Rick Ryder from BlackRock.
Interesting. From the world's largest asset manager to the world's most powerful central bank. That would be quite a transition.
It would be a massive shift, certainly. But for now, the takeaway for you, the listener, is that the Fed is paralyzed by this internal and external conflict. They held rates because the data, that 5.4% growth, is just undeniable. It forced their hand. But the political pressure to cut is not going away.
Okay, so while the Fed is fighting its civil war over the cost of money, let's pivot to where that money is actually being spent, because there is a massive story coming out of Seattle today.
Amazon.
And the numbers here are just staggering. We're talking about 16,000 corporate job cuts.
And that is on top of the 14,000 cuts they announced back in October 2025. So you add that up, and in just a few months, we've seen roughly 30,000 people let go. And it is so important to clarify, these aren't the folks packing boxes in the warehouses. These are not the delivery drivers. These are corporate roles, tech roles, the white-collar layer of the company.
That's about 10% of their entire corporate workforce, just gone, just like that.
A massive, massive reduction.
But what's fascinating to me is the way they're framing it. The CEO, Andy Jassy, he isn't saying we're broke, we need to save money. He's saying we need to operate like the world's largest startup.
That is the phrase that just jumped off the page at me, too.
Yeah.
The world's largest startup. It's an oxymoron, really.
Right.
You can't be a startup when you have $1 trillion market cap and hundreds of thousands of employees. It's impossible. But what Jassy is trying to do is force a cultural reset.
It's this anti-bureaucracy diet. I was reading through the notes on the internal memos, and they're implementing some really specific, almost aggressive cultural changes. And one term kept coming up over and over, span of control.
Span of control. It sounds like something out of a sci-fi novel, doesn't it? But it's actually a very old management concept. It basically just asks, how many people report directly to you?
Okay, so why does that matter for a layoff? What's the connection?
Well, in a lot of bloated organizations, and Amazon has basically admitted they became bloated during the pandemic hiring boom, you get what we call tall structures. You have a manager who manages another manager, who manages another manager, who finally manages the person who's actually writing the code.
So if I have an idea, it has to go through 4 layers of approval before anyone even sees it.
Exactly. And at each one of those layers, the idea gets diluted, or it gets delayed, or it just gets killed. Jassy wants to flatten that pancake. He wants to increase the span of control, which means each manager has more direct reports, but there are way fewer layers of management overall.
So more doers, fewer managers.
More individual contributors, people actually building things, and fewer coordinators or overseers.
But he's taking it a step further than just rejiggering the org charts. Get this, they created a no bureaucracy email alias.
The snitch line.
It's literally a snitch line. If you see something stupid or slow or a meeting that could have been an email, you are encouraged to report it to this alias. It's wild. It feels very militant.
It really does. And I think it speaks to the desperation, to regain that agility they had in the early days. Beth Galetti, the SVP of People, she sent out a memo trying to calm people down, insisting that this isn't a new rhythm of constant layoffs.
So she's trying to reassure the survivors.
Right. She's saying this is a strategic reset, not a death spiral.
But here's the skeptical question. Why reset now? The stock is doing great. They have tons of cash. Why cut 30,000 smart, talented people? Is this just corporate greed?
No. And this is the key insight for you, the listener. This is the Theta Fuse. Usually when a company fires 10% of its staff, it's because they're in trouble. Amazon stock is near an all-time high. They aren't cutting to save money to put it in a vault.
So what are they doing?
They are cutting humans to buy compute.
To buy compute?
Exactly. The cuts are funding a massive all-in pivot to AI. If you look at their capital expenditure forecast for 2026, their CapEx Amazon expects to spend $125 billion.
$125 billion with a B in 1 year.
In 1 year. That is the highest spending forecast among all the mega-cap tech companies. That is more than the GDP of most nations on Earth. And the vast majority of that is going into artificial intelligence and the data centers to power it.
So they are literally firing middle managers and hiring GPUs.
Essentially, yes. They are trading payroll for silicon. And we're seeing this in their other strategic moves, too. They're closing down the Amazon Fresh and the Amazon Go stores. Remember those cashierless stores?
Yeah, the just walkout technology. I thought that was the future.
It was the future 5 years ago. Now, in their own internal language, it's a failed experiment. They are shutting them down to shift those resources towards something they call agentic AI.
We keep hearing this term, agentic AI. How is that different from, the ChatGPT I used to write my emails?
It's a massive difference. It's a whole other ballgame. ChatGPT is passive. You ask a question, it gives you an answer. It's a really, really smart encyclopedia. Agentic AI does things. It has agency.
Give me an example. What does that mean?
Okay, so instead of asking an AI, what are the best practices for optimizing my supply chain? An agentic AI would be connected directly to your systems. You would just say, optimize the supply chain.
Yeah.
And the AI would go out, negotiate new contracts with your suppliers in real time, reroute shipping containers based on weather patterns, and update your inventory database automatically. It takes action in the real world.
So if you have an AI that can negotiate a supply chain contract, you don't need the supply chain manager.
That is the Theta Fuse. The old asset is the middle manager coordinating the work. The new asset is the agentic AI and the massive data center that powers it. Amazon is literally trading human capital for silicon capital.
And this spending spree isn't just happening inside Amazon's walls. It has to be creating ripples across the entire market. If Amazon is spending $125 billion on hardware, somebody has to be selling it to them.
Oh, absolutely. We saw that in the earnings reports today. Look at a company like ASML. They make the complex machines that make the microchips. They reported record orders, $15.8 billion. But the real surprise, look at Seagate.
Seagate, the hard drive guys? I didn't even know they were still a thing.
The hard drive guys are very much a thing. Seagate stocks surged over 17% today. Why? Because agentic AI generates a massive, unbelievable amount of data. If the AI is negotiating contracts and rerouting ships, it needs to remember what it did. It needs logs. It needs training data. All that data has to live somewhere.
So the data centers need more and more high-capacity storage.
Precisely. The Seagate CEO, William Mosley, he explicitly talked about agentic AI creating a tsunami of data generation. He's seeing it in his order book.
So the takeaway here is that Amazon is shedding its old tech bloat, the retail experiments, the layers of middle management, to survive the AI arms race. They are burning the furniture to feed the engine.
That is a very, very apt metaphor. It's a huge gamble. They are betting that a leaner, meaner, AI-focused Amazon is worth more than the sprawling empire they built over the last decade.
Speaking of sprawling empires and government intervention, let's pivot to our third core discussion point. We've talked about the Fed squeezing the economy and Amazon squeezing its workforce. Now let's talk about the government giving money away.
This is the Trump account story, and it connects directly to that Theta Fuse theme of opportunity. It's a really interesting development.
I keep seeing this term Trump accounts all over the place. Break it down for us. What exactly are they?
So this is a program that's embedded in the One Big Beautiful Bill Act.
Of course that's the name of the bill. Of course it is.
Laughs. You have to appreciate the branding. But the mechanics are actually quite simple and, honestly, potentially transformative. The U.S. Treasury is going to deposit $1,000 into a tax-advantaged retirement account for every single child born in the U.S. between January 4th, 2025 and December 31st, 2028.
Okay, so if you have a baby in that 4-year window, Uncle Sam drops $1,000 into an investment account for them. Is that it?
That's the start of it, yes. The stated goal is to narrow the U.S. wealth gap by encouraging investing from the moment of birth. The idea is that compound interest is the most powerful force in finance, but you have to start early to really feel its effects. If you start with $1,000 at birth and you just assume a standard market return, that money has 65 years to grow.
And even if you don't add another dime, that $1,000 turns into, what, $50,000, $60,000?
Depending on the rate of return, it could be a really significant amount by the time they retire. But the real power comes if the family or the employer adds to it. And that is the big headline today. It wasn't just about the government's plan. It was about corporate America's reaction.
That's the surprise. Major U.S. banks and corporations are voluntarily stepping up to match this contribution for their employees.
The heaviest of the heavy hitters. JP Chase led the charge. Their CEO, Jamie Dimon, explicitly endorsed the program in a statement.
Wow.
Bank of America followed suit almost immediately. Then BlackRock, Robinhood, SoFi, Charles Schwab was like a domino effect.
So if I work at, say, JP Chase and I have a kid this year, I get $1,000 from the Treasury and then another $1,000 from Jamie Dimon.
Exactly. Your child starts life with $2,000 in a tax-advantaged investment account before they can even walk.
That is a massive head start compared to starting with zero. But why are the banks doing this? Is this just charity? Or is there a hook? What's the catch?
There is always a hook. I mean, think about it. These are tax-advantaged retirement accounts.
Yeah.
I mean, the money's locked up. It's sticky. If JP Morgan opens an account for your kid on day one, that kid is very likely to be a JP Morgan customer for the next 60 years.
It's customer acquisition at birth. Genius.
It is. But it also signals this rare moment of alignment between a populist government policy, give money to the people, and Wall Street, put that money in the market so we can manage it.
But it's not just the bankers, is it? The cultural phenomenon around this is just, it's bizarre. The coalition of support is unlike anything I've ever seen.
It is an extremely odd coalition. You have the billionaires, obviously. Michael and Susan Dell pledged their support. Ray Dalio is on board. But then you have pop culture.
This is the part that broke my brain this morning, Nicki Minaj.
The laughs. Yes. The rap artist, Nicki Minaj, has pledged her support for the Trump accounts.
I just want to sit with that image for a second. Jamie Dimon, the buttoned-up CEO of JP Morgan, and Nicki Minaj standing on the same side of a financial policy debate. It's surreal.
It really highlights the strange populist appeal of this specific policy. It seems to cross traditional party lines and, cultural lines. It's about building wealth.
Yeah.
That is a message that resonates just as much with a hedge fund manager as it does with a rap superstar.
It really is something else. But I guess if it gets more people investing for the long term, maybe the messengers don't matter so much.
That seems to be the logic. And for you, the listener, the takeaway is pretty clear. If the government and your employer are handing you free equity for your children, you take it. No questions asked.
Absolutely. Okay, we've covered the Fed's paralysis, Amazon's pivot, and the Trump accounts. But the market itself was absolutely wild today. We need to do a rapid-fire round on the market pulse because there are some moves that we just cannot ignore.
Let's do it. Where do you want to start?
First up, gold. We touched on this briefly, but gold futures topped $5,300 an ounce.
$5,300. That is a new historic high.
Right.
And the driver here is what analysts are calling the debasement trade.
Unpack that. Debasement trade, what does that mean?
It's fear. It's pure and simple fear. Investors are looking at the U.S. debt, which is growing by the second. They're looking at the political instability at the Fed, which we just spent 20 minutes discussing. And they are looking at a U.S. dollar that hit a 4-year low earlier this week before it stabilized. They are fleeing fiat currency.
So people are basically saying, I don't trust the paper money you're printing. Give me the yellow metal that's been around for thousands of years.
The Brookings Institution had a quote today that summed it up perfectly. They said, "Dollar weakness is supercharging the rise in gold. It's a global vote of no confidence in the system's ability to hold its value."
Which brings us, naturally, to the other store of value, crypto.
Crypto is definitely rising too. Bitcoin was up about 1.9%, Ethereum up closer to 2.9%. But the big news there isn't the price, it's regulatory. The Clarity Act overcame a major hurdle in the Senate today.
And for crypto, any regulatory clarity is usually bullish, right? It means the rules of the road are finally being painted.
Exactly. For years, the entire crypto industry has been screaming, just tell us the rules and we'll follow them. The Clarity Act does that. It signals legitimacy. It tells the big institutions like BlackRock and Fidelity that it's safe to enter the water because the government isn't going to suddenly ban it tomorrow.
Okay, next big win. Seagate. We mentioned them with Amazon, but the stock was up nearly 19%, trading around $441 a share.
This is the pure AI infrastructure play. We keep talking about the chips, NVIDIA, AMD, all of that. But chips need memory. They need storage. If Amazon's agentic AI is going to run the world, it needs a really, really big hard drive to store all that data. Seagate is the picks and shovels play here.
And finally, I saved the weirdest for last. We have a rumor about SpaceX.
The Financial Times broke this one. It's a report that SpaceX is seeking a valuation of $1.5 trillion in an upcoming IPO.
$1.5 trillion. That would make it one of the most valuable companies on Earth instantly. Bigger than most countries. But it's not just the number that's incredible, it's the timing.
This is classic Elon Musk. It's pure narrative building. The report says he wants to time the IPO for mid-June. Why mid-June? Two reasons. One, it coincides with his birthday.
Of course it does, because why not throw yourself $1.5 trillion birthday party?
And two, and this is the incredible part, because of a rare planetary alignment of Jupiter and Venus.
Tricking me. He's timing his IPO to astrology.
I am not kidding. He wants to list the most advanced rocketry company in human history on the public markets during a planetary conjunction.
That is, look, say what you will about the man, but he knows how to build a narrative. Timing a financial listing based on the stars. It's both completely absurd and absolutely brilliant at the same time.
It certainly keeps people talking. And at a $1.5 trillion valuation, it seems like the market is willing to listen to the stars. I guess if the rocket works, nobody really cares about the astrology.
So what does this all mean? We've covered a lot of ground today. We have the Fed freezing rates because the economy is just too hot despite all the political screaming. We have Amazon firing humans to buy robots. We have the government handing out investment accounts to toddlers.
And Elon Musk consulting star charts for his IPO.
And Elon Musk consulting star charts. When you sum it up like that, it just sounds chaotic. But there are threads connecting all of this, aren't there?
There are. You just have to zoom out a little to see them.
Let's pull those threads together for the Theta Fuse takeaway. If I'm a listener sitting here on January 28, 2026, looking at all this madness, what do I do?
I think the message is, don't get distracted by the noise at the top. The big players, Powell, Trump, Jassy, they're fighting over the macro levers. They're fighting over bureaucracy and interest rates and politics. But your job is to stay grounded in the reality of the shift that's happening underneath them.
And the shift being the move to AI and hard assets, is that the signal?
That's the signal. Don't panic because your mortgage rate didn't drop today. The economy is growing at over 5%. That's fundamentally good for your earnings potential. But you have to look at where the capital is flowing. Amazon isn't spending $125 billion on nostalgia.
Right.
They're spending it on the future data storage, AI infrastructure. Gold is rising because people want a real store of value.
Follow the CapEx. Follow the smart money. And don't bet on the old way coming back.
And take a page out of the Trump accounts book. The government itself is realizing that the only way to build real wealth is time in the market. If they're doing it for toddlers, you should be ensuring you are doing it for yourself. Compound interest doesn't care about politics. It just works.
And I want to leave you with this final provocative thought. We talked about Amazon trying to act like a startup again. They are 30 years old, they are massively successful, and yet they are terrified of becoming slow and bureaucratic. They are ruthlessly cutting the old to fund the new.
It's a survival instinct, plain and simple.
So ask yourself, are you managing your own portfolio, and more importantly, your own career, with that same level of urgency? Are you holding on to old skills or old investments just because they're comfortable? Or are you willing to put yourself on an anti-bureaucracy diet to future-proof your own life?
That is the question to sleep on tonight. Are you waiting for the old rhythm to come back? Because looking at Amazon and the Fed and everything else, I don't think it's returning.
I don't think so either. Thanks for diving in with us. We'll see you next time.
Take care.